Welcome to Markets Now. I'm Michelle Rook along with Kent Beadle with Paradigm Futures. Livestock did the plus side here as we roll through the mid-session with the grain futures mixed. Corn slightly lower following wheat, which has scored some new contract lows in Chicago again today. Soybeans a bit higher. And Kent, good to have you along. Let's talk about the soybean market. We're holding up here pretty well, but some of this is report positioning with anticipation of some lower yields in tomorrow's WASDE, right?
Absolutely. The soybean balance sheet is the balance sheet that's the tightest going into the report. 240 million bushels on the balance sheet that the USDA is carrying today doesn't maybe seem all that tight, but it's actually lower than what they're currently reporting for this upcoming new crop endings or old crop ending stocks, and then the prior year's ending stocks. And so if you consider the price levels that we've had in beans the prior 2 years and the inverses that we had seen in the marketplace, a 240 million bushel carryout is tight. And now if you potentially take a bushel off of that, maybe more, depending on just how badly the heat actually hurt this soybean crop the last 3 weeks, as well as the dryness. You're talking about a rationing situation again, where we're going to have to pull bushels out of exports in order to have a pipeline minimum ending stocks.
Yeah. So corn has been trying to follow soybeans, trying to price in maybe a little bit of yield cut as well, despite the fact that the wheat market is kind of holding no prisoners today. Talk about corn and what you expect in terms of yield adjustments in tomorrow's WASDE, and then follow that through ending stocks, and maybe even talk about those harvested acres we're concerned about.
Yeah. So, starting with yield, the big question that the market's trying to solve for is from what level are we subtracting from? Because we know that we've lost some yield pushing this crop to maturity as quickly as we are pushing it. We're fairly certain that there's variability out there. We saw that in the crop tours. But there was also some really good corn out there. And we've also had a history of maybe surprises to the positive side in terms of yield in years where we have warmer, drier conditions. And of course, we had that good early August, and we had decent weather for pollination. So, my expectation is in that 172, 173 area. That's a fair bit lower than where I was at 2-3 weeks ago. I thought we could have had as much as 177 bushels an acre, higher than the last USDA estimate. But the weather of the Labor Day weekend, particularly, and really just the last half of August and the first 11 days of September, have sapped enough yield that we think we're back down in those low 170 area. Probably about 172.5 would be my guess.
Will that be offset at all, Kemp, by some higher harvested acres, or what do you see happening there?
Yeah, the expectation is that the FSA data is going to get incorporated tomorrow. They'll give us revised FSA data relative to what we saw in August, but the August data suggested that we were going to see an increase in harvested acres. It's always hard to say just how much. But right now, I think the marketplace is pricing in at least 100, maybe 200,000 additional harvested acres for the report tomorrow that'll offset that loss in yield at least a little bit. I think we're probably looking at a production estimate right now that's down 60, 70 million bushels, and it offsetting the yield and the harvested acreage.
So then ending stocks will still likely be over 2 billion bushels?
Yes, they will. And, it's always an expectation from the USDA that when they do lower yield, they have a knee-jerk reaction to tend to want to lower our usage as well, the demand side of the balance sheet. We would think that that's a mistake this year for a few reasons. Number one, we are seeing export demand start to pick up in corn, maybe a little bit surprisingly given the safrinha crop, but it is starting to happen. The last 8-9 weeks, we've seen an uptick in new crop exports. Saw even today a fairly decent export inspections number That number's been growing week over week. We see margin in the ethanol business. We see margin out in deferred hogs. And of course we've got very expensive cattle and a lot of demand for the smaller number of feeder calves that we have out there. So we still think demand is probably going to be pretty good, and we think it would be a mistake for them to lower demand on this report just because they cut supplies, primarily because we have enough bushels to support a higher demand base.
You bet. So as I mentioned, the wheat market is holding back corn to some degree here today with more contract lows in Chicago wheat. How much lower do you think we need to go there? Because, is the market buying into this idea that we have these bigger Russian supplies, or is this a weather issue that we're trying to trade here today because of some of these forecasted rains, or what?
Well, I think it's the issue is twofold. You do hear reports out of the Black Sea, particularly out of Russia, that they have larger supplies to export, and that they're being very aggressive in pricing those supplies. So that's issue number one. Of course, the second issue has actually been the dollar. Now, it may be a little bit lower today, but we've actually had a higher dollar close 8 consecutive weeks for the first time we've had 8 weeks of higher closes since maybe 2015. That higher dollar is certainly, having an impact on the value of exports coming out of the U.S. And of course, it isn't as if we had a big wheat crop, right? So, even though the hard red winter wheat crop was larger than initially expected because we finally did get some rain in the southern plains, the spring wheat crop, was forecast to be smaller. We think the spring wheat crop goes up on tomorrow's report. By the way, we heard better than expected yield results. That's weighed on wheat a little bit. You do have a smaller Canadian crop, however, and those smaller U.S. crops than maybe historical crops have put U.S. prices still at a fairly sizable premium in the hard wheats over most of the world markets. The Chicago wheat, on the other hand, is probably priced pretty fairly into world export markets. But again, the Russians are just being very aggressive in how it wants to price its exports.
Gotcha. Cattle market. We are scoring some all-time highs again today in the feeder market. Live cattle futures have yet to do that, even though we've had this trend of a little bit better cash trade last week. So will feeders be able to push live cattle into those contract high areas or not?
Oh, I think ultimately they will. We continue to run through some liquidation of a very long speculative position, and that has kind of stopped us on rallies here previously. We ultimately think that the smaller cattle supplies are going to be enough to push us into new contract highs. And one caveat to that, and the big caveat, is if we start to see the consumer react negatively to these higher prices. They really haven't done so yet, but if we do shoot to new contract highs and we see, the impact of the potential of recession, for example, possibly start to, weigh on the consumer's pocketbook and make them a little bit more price sensitive, that could keep that cattle market from, moving substantially into new highs, and conversely might, give us a nice boost in pork demand.
You bet. And let's talk about pork. The pork market, we've seen cutouts kind of advance here this last week. Good underlying demand there. Is that what's helping to push the market here today, or is this just a technical play here because we held some trendline support areas we needed to on Friday?
We did hold some trendline support. I think the big thing was the cutout being a little bit higher last week. My sense is that the heat that we had over Labor Day weekend took its toll on weights and on nearby supplies, and that helped from the cutout up a little bit. If that's the case, our expectation is going to be that we're going to see cutouts start to move seasonally lower once again. We still hear fairly good supplies in the barns out there, and seasonality typically kicks in. We expect lower hog prices. We expect lower cutout prices. The one thing that we're keeping an eye on, of course, course, is this spread between pork and cattle. And as I mentioned earlier, if you start to see consumers get tired of the high beef prices, we may see that demand start shifting over to pork a little more substantially.
Very good. Thanks for joining us. Kent Beadle with Paradigm Futures. That is Markets Now.